Morning, everybody. My name is Josh Amster. I am the VP of Sales here at StartEngine and will be the one hosting today's webinar on venture capital versus equity crowdfunding and trying to determine which funding pathway is right for your business. There's so many times when we speak with prospective customers and entrepreneurs about the funding options out there, and thought as a result it'd be a great topic of discussion here to highlight the both options, the pros and cons, kind of the state of where each funding pathway exists today, and so that's what we'll be discussing. So it'll probably be around 20-30 minutes in presenting, and then we'll leave some time as well for the for questions. So if you all have questions as we go through this, you'll see there's a little Q&A icon on your Zoom toolbar. So if you click on that Q&A button and submit your questions, I'll then be going through those at the end of this webinar today and can hopefully get through as many of them as possible so that everybody leaves with their question answered. So I'll present for the next 20-30 minutes or so, and then I'll get into those questions. But I do encourage you to submit those as we go along so that we can make sure to address everybody's questions as soon as we can. So as I mentioned, today's agenda basically, first we're going to look at the investment activity today and sort of what's happening in the equity crowdfunding space, what's happening in the venture capital space, especially during this time in the pandemic, and get a sense sort of the activity that is going on in each arena. We'll talk about the typical deal flows that we're seeing in both spaces, as well as the deal sizes. Tend to be a bit different between the two funding pathways, and so I think it'll be important to explain that in more detail. We'll go into some of the strengths and weaknesses here on both sides, as definitely there's pros and cons, and then we'll leave some time at the end for Q&A. So as I mentioned, I think the one thing that's really important for entrepreneurs to understand is how are investors reacting in this COVID-19 pandemic. You hear a lot of concerning news in the space. Investors may be shying away from things. And so how will that affect the company that needs to go out and raise capital today, given the climate that we're in? So I think what we're seeing from the venture capital space is a considerable drop in the valuation. You were seeing these VCs investing at huge valuations, tons of billion-dollar unicorns out there, and all of a sudden now those numbers are declining significantly. So you're seeing, if deals were valued at 10 times, they're now coming down to five times, or considerably cheaper prices given the climate that we're in. We're also seeing that VCs are taking fewer meetings and investing in fewer deals. They're taking more of a conservative approach at this point, maybe not even investing in new businesses, but more so looking at their current portfolio and determining which of those companies are going to get additional capital during this period of time, because they don't have as much money to be dishing out, and so they need to really invest that money wisely. And we have a really interesting chart here that talks about how COVID-19 is affecting daily operations for some of the biggest venture capital firms out there. So if you take a look at this chart, the two biggest sections of the pie would be taking fewer meetings. So 27% of these VCs are taking fewer meetings, and then 27% of them as well are focusing on their existing portfolio versus new opportunities, as we just discussed. The next biggest chunk would be 20% slowing their investment pace. So if they were maybe making, I don't know, about 11 or so investments a year for a fund, maybe that's going down. Maybe they're investing in 5 or 6 at this time for the 2020 calendar year. And you can see some of the other smaller sections as well, but those three sections of the chart really kind of make up the majority of how this pandemic is affecting venture capital. You can also see sort of how venture capitalists behave in a recession. So you can see the lighter green line is the total number, the total invested dollars versus the darker green line is the number of investments that venture capital firms have made. And you can see a sharp decline after the year 2000 when the dot-com bubble burst. You can also see a sharp decline around the 2008-2009 area with the most recent recession that occurred. So generally speaking, when there are these times of recessions, the venture capital firms will sort of shrink their investments. And there are people that are out there feeling that this type of recession may be coming on as well, given this COVID-19 pandemic. The public markets have been extremely volatile during this time. I think as volatile as they've ever been. The NASDAQ is performing quite well this year. But besides that, the New York Stock Exchange, the S&P, the international markets, all in sharp decline. So it's going to be really interesting to see, what happens moving forward. It's a bit unpredictable, but you can get a sense if people do feel a recession is coming, these are how the venture capital firms do behave during those times. Now, in comparison, here's what's been going on StartEngine during this COVID-19 pandemic. So this graph here will illustrate the amount raised over time. So it's actually the amount raised on a daily basis. And the graph starts in early March and it runs through mid-June, basically up until today. And what you see is a steady increase in investment on a per day basis on our platform. So at the beginning, when we were probably doing around $100,000 a day or so, that number is now climbing sometimes above $500,000 a day in investment. And so this has really been an incredible development that we've seen on our platform over the last couple of months. And there really shows no signs of slowing down. I'm the one at the company that actually tracks our investments on a daily basis and on a weekly basis. And normally we were doing pre-COVID around $1 million a week. Some weeks a little bit higher, some weeks right on it, some weeks a little bit less. We are now consistently seeing that over $2.5 million is being raised on our platform every week, sometimes going as high as $3 million a week. So it's been a tremendous, tremendous time for our platform. The demand is as well as high as it's ever been because, as you know, companies are hungry for capital and there's less investment out there available to them. And so they're seeing the numbers that are going on platforms like StartEngine, and they're really strongly considering now this as their next capital raising pathway. So let's talk a little bit about the deal flow then and what you should expect on both sides of the coin here. So with venture capital, what we're seeing is that there are roughly around 1,000 venture capital firms in the United States, give or take. And the volume is in 2019, venture capital firms invested in about 11,000 companies. And 2,500 of those were late stage deals. So, Series C, D, E, whatever it might be, not new investments. So, there are 5 million small businesses out there in the United States. And as you can see in 2019, 11,000 of the roughly 5 million companies were able to get venture capital investment. So a tiny, fraction of the small businesses out there are able to actually secure a venture capital investment. On the other side, equity crowdfunding, right now there are currently 54 funding portals in the United States. StartEngine, for example, is a funding portal. That's the term that FINRA, or the regulating body, has given to platforms like StartEngine. So there are 54 currently today, and that number is actively rising. In 2019, there were 735 regulation crowdfunding offerings filed with the SEC. 143 of those were actually on StartEngine. So StartEngine alone did about 143 offerings in 2019, whereas a typical VC firm is going to be doing around 11 or so investments in a given year. So you can just see from a volume standpoint, there are way more companies out there raising capital on StartEngine, whereas it's extreme selectivity on the venture capital side, and most entrepreneurs are shut out of being able to secure a VC investment. We at StartEngine, along with all our competitors in the industry, are eager to get more and more investments and entrepreneurs on our platforms to be able to help them. As I mentioned, there's 5 million small businesses out there. So being able to raise funds for 735 of those is not what we want. We want it to be way bigger than that, but it's also early days. The regulation crowdfunding rule came into effect in May of 2016. Reg A came into effect in June of 2015. So it's been, 4 or 5 years since these regulations first, were enacted. And so it's going to take time to build up. But as you can see, especially with StartEngine, the rate of our volume here is picking up considerably. And that number has only been increasing this year as well, especially during this pandemic that we're all living in today. Going into some of the geography and the diversity of companies that are raising on our platform. So VCs, what you see is 80% of the money goes to the top 5 metro areas. Generally speaking, Silicon Valley, New York, Los Angeles, Austin, Texas, Chicago. Those are kind of, when the companies are around there, those are the types of businesses that are getting investment from the VC firms. Also regarding diversity, in 2019, 11.5% of the VC funded companies went to a team with a female co-founder. And this is, to us, a huge problem. On the other side of the coin, as you can see with equity crowdfunding, 42% of the Reg CF offerings went to companies outside of the top metro area. So close to half of the offerings are coming from all over the United States, not just those big metro areas. And then with the diversity, you can see definitely better, still not where it needs to be though. Around 28% of the Reg CF offerings were to teams with a female founder or co-founder. So definitely a nice step in the right direction, but I think there's a lot more to be worked on and improved there, because entrepreneurs of any kind should be able to get access to capital. And it's our belief that, real true innovation dies by the lack of capital out there, and that's just not acceptable. So StartEngine is here to try to make a difference, to really democratize capital, allow it for as many entrepreneurs as we possibly can. And that's what this is really all about. So with the deal size, as you can see here, and this is sort of the blueprint of, how entrepreneurs and founders are trained to think, is you do, a pre-seed, a seed round, Series A, B, C, in the life cycle of a company. So in VCs, the pre-seed rounds tend to be less than $1 million, and most of these VCs actually don't even invest at that stage. That tends to be more of a friends and family round, where the company goes out to their closest family members and friends and is able to maybe secure a few $100,000 of capital from those people. Once they do that, they will then move into a seed round. The average seed round for a VC is around $1.7 million, and that kind of gives them their first infusion of capital to really kind of spearhead the company and allow for tremendous growth. The next step shortly thereafter would be a Series A. The average Series A deal is for around 15.6 million. And so this is kind of where lead investor, the VC firm that probably invested in the seed round, they bring on some other VCs, and they increase that level of investment pretty considerably once they've seen that the company is able to achieve certain measurables within its business. But then if they provide a large sum of capital to really put the gas pedal down, they can accelerate their sales and numbers to hopefully then get the return that the VC is interested in achieving. With equity crowdfunding, it's a little bit different. StartEngine has a different philosophy on things. We really believe in this always be raising mentality, but you could still sort of follow this progression of pre-seed, seed, Series A, Series B, and accomplish those through the regulations that we operate under. So if you want to think of a pre-seed round, that could be a regulation CF round. Reg CF, you can raise up to $1,070,000 in a given year. So every 12 months, you can achieve that. And right now, StartEngine, at the average Reg CF raise is about $357,000. So that's typically what the pre-seed round will be. Could be a little bit less, could be a little bit more, but generally speaking, that's the numbers that we're seeing. One thing to note as well about regulation crowdfunding is that cap of $1,070,000 we'll be increasing up to $5 million. And so that'll kind of help the industry tremendously, but it might also kind of change the roadmap that some of these companies go down, because after they raise $1,070,000, they normally go into Regulation A plus, and that's where companies can raise up to $50 million in a given year. And the average raise for Reg A on StartEngine right now is around 2.7 million. So what we see is our companies will go, they'll raise $1 million on Reg CF, then they'll come back and they'll do a Reg A round and they'll raise around $3 million, and then they may come around and do a follow-on round. And this is sort of what you see at the very bottom here for maybe $10, $15 million, and that could be a Series A, for example. Nightscope is a company that's raising right now. They've raised currently $14.2 million. Elio Motors is a company that we raised capital for early on. They raised $17 million. And TerraCycle is another company that's currently raising on our platform, and they're currently at $13 million. So I think when you'll see is that when Reg CF goes up to 5 million, you'll see companies do a seed under Reg CF, a pre-seed under CF, a seed under CF for maybe up to 5 million, and then a Series A for maybe up to 10 to 15 million. And you can still easily follow that progression that you see in the more traditional VC investment world. So now I want to talk about maybe which is right for your company, and talk about the pros and cons of each. So I think with venture capital, some of the pros is obviously these companies have deep pockets. They're big funds, 100 million, 200, $1 billion funds that they can provide a large amount of capital to a business that fits their model very, very quickly. You definitely see that they have experience in guiding these high growth companies and giving them the mentorship that they need to achieve. And they may have the ability to connect you to a network of other founders and valuable resources. So it's could be a potential strategic investment as well. I do think that with equity crowdfunding, there's a lot of strategics involved because if you're successful, you're bringing on hundreds, if not thousands of investors into your company. And the likelihood that one or two of those individuals may know somebody within your space that could be helpful to you is very possible and likely, I would say. And we've seen that with us, and I'll go into that in a bit more detail later on. And then sort of the virtue signaling to the industry. So I think there's this prestige that, companies that get VC capital believe that they have. Oh, I was able to, secure a $10 million investment from Sequoia or things like that. I think there's this sort of prestige and signaling that maybe puts out, which then maybe leads to some positives for the business moving forward. On the cons, as we talked about, less than 1% of the companies out there actually do receive VC funding. So it's really for the elite. And it's not going to be for every company out there. You could get meetings and pitch all day long, but the likelihood of you being able to secure that investment is very low. The VCs, they have their models, they have their beliefs, and what they want to do is they want to get the lowest valuation that they possibly can for the business to increase their upside later on. So there's going to be significant downward pressure on your valuation. In addition, there's terms that are in those deals that could be very toxic for the entrepreneur in the business. First off, they're going to only come in on preferred shares. They're going to come in at the highest level there and make sure that they have priority on everything when it comes to distributions in the future. They could have anti-dilution rights, recap preferences. There's all of these types of things that they could do to basically position themselves in a positive way that ultimately can, force out the founders of the company if they don't like the direction that the business is headed. And that sort of kind of talks about the next point here is they can really exert their influence over the direction of the company. Generally speaking, they're always going to require board seats as a part of their investment. They're going to be sitting on that board and have a very influential role in things. And a really interesting stat that we found is that 40% of CEOs that get VC investment are gone within 3 rounds of that VC investment. 40% of the founders, the CEOs of these companies are forced out of their own business after a couple additional rounds because the financiers, the VCs, are not excited or comfortable with the direction that they're taking the company. And that's a really, really powerful statement and stat. And then lastly, they put tremendous pressure on these companies to grow extremely quickly, almost to an unsustainable level, so that they can be able to generate the return for the firm that will give them, the kind of the return on their investments they have projected. So it can be a bit toxic. It can require so many other problems with communications as these teams grow from 100 people to 1,000 people almost overnight. There's definitely some growing pains and challenges that come with that. On the other side, equity crowdfunding. So one of the pros is you set your own terms and you're able to maintain control of your company. There's not going to be any force out. Generally speaking, the companies on our platform, they sell common shares, and they're normally set up with a proxy so that they're non-voting common shares. So basically, at a valuation that you've determined yourself, you're not going to lose control of your company. You're going to continue to drive the ship wherever you want to go. And I think that's really an incredibly compelling point that all of our entrepreneurs on StartEngine value greatly, is they want to maintain control and not give it up to a VC or some other investor that comes in. As we talked about in equity crowdfunding, you're building a huge army of brand ambassadors. If you're successful, you're going to have thousands of investors, and those people are going to be able to tell their friends and their communities about your company. They can be customers of your company. They can introduce you to people that they know. There's so many powerful things that having a large base of investors can provide, and that's really one of the other benefits that you get in the equity crowdfunding space. If you're successful here in equity crowdfunding, your raise will accomplish multiple things at the same time. Not only are you going to raise the capital that you need, but because marketing is a big factor in this, your brand equity is going to increase tremendously at the same time. And then lastly, if there's a way for you to incorporate sales into your raise by offering perks, companies should do that. It's not necessarily possible for all businesses, but for example, consumer-facing companies, you could offer discounts in addition to the shares of equity that people are purchasing. So if someone buys shares, they could maybe then receive a 20% discount on products. And what you'll see is the investor will buy their shares, they'll go on your website, they'll buy products, and your sales numbers will be going up at the same time. So it's a really multi-dimensional offering that equity crowdfunding provides. And then lastly, you can raise consistently under these regulations. As I mentioned, Reg CF allows you to raise up to $1 million every 12 months. Reg A allows you to raise up to $50 million every 12 months. And those numbers are going up. Reg CF is going to go up to 5 million. Reg A is going to go up to 75 million, hopefully by the end of this year. And that's just going to make it even more attractive to companies out there, are these increased caps. On the other side, there's no guarantees. So when you're sitting across the desk from a venture capital investor and they say they're going to write you a $3.5 million check, if you sign on the dotted line, that $3.5 million check is coming in. With equity crowdfunding, there is no guarantee. You have to go out there. We have to market this thing together. We have to try different channels. And even given all of that, it still may not work. And so that's one thing that entrepreneurs need to understand, is there are no guarantees here. But with the right type of strategic planning, messaging, marketing strategies, we feel that we are able to generate a success for the business, whatever amount that may be. Number two is your financials are public information here. So because these offerings are open to non-accredited investors and the general public, you need to be transparent about your company and what you do. So financials will be a part of the Reg CF offerings and the Reg A offerings. And beyond that, there are reporting obligations that the company has post-raise. For Reg CF, it's once a year. For Reg A, it's twice a year. This is very, very different than reporting for a public company where it's quarterly. There's Sarbanes-Oxley provisions that the company needs to abide by. It's very different than that. It's really just an annual report on your financials and any other pertinent updates on the business. And that happens once per year. Probably only costs around, I'd say, $2,000 to $5,000 to even produce those reports. So very, very cost efficient, and it's not going to be overburdensome by any stretch of the imagination. And then lastly, with equity crowdfunding, is there are costs to raising money. There are costs for legal vendors, there are costs for accountants, the platforms charge fees, and there's costs to market the raise. Digital advertising is a really successful strategy that companies utilize to raise money from the public, but you're going to have to spend some money to be able to raise the money. And so that's a critical piece to this that the founders need to understand. So regarding sort of the belief in that, is this something that's really possible, and can you do this multiple times and achieve that pre-seed to seed to Series A? 51% of the companies on StartEngine believe in equity crowdfunding so much that they have returned for a second or even third funding round on StartEngine. So over half of our companies that we work with come back and do multiple rounds with us. And I think that just speaks volumes to the benefits that these entrepreneurs see in raising capital from the general public. So over half of them are coming back for follow-on rounds. At StartEngine, not only do we obviously tell companies to raise capital via equity crowdfunding, but this is something actually that we do ourselves. And I think that's really important to share with everybody today is we practice what we preach. We eat our own dog food. And I think it'll be kind of interesting to hear sort of our story and where we've gone as a company during our life cycle. So, you know, currently today we've raised over $20 million from over 10,000 shareholders. So we have a huge army of shareholders here that is a great asset for the business. We've done 4 regulation crowdfunding offering ourselves. We've completed 2 Regulation A offerings. We're currently in the midst of our 3rd one right now that we just launched a couple weeks back. And as I mentioned, that 10,000 person shareholder community is, for us, it's the most valuable asset in our company. These individuals, they bring us new companies to raise on our platform. They bring us employees to work at our firm. They, you know, invest in the other deals on our platform because they're incentivized to do so. It really, they test new features that we have regarding sort of investment product developments that we're pushing out. This community really is incredible for us. And they're not a burden whatsoever. I think one of the questions I get so much is, how do you handle having so many shareholders in the company? And it's quite simple. It's a very different relationship when someone puts in $500 or $1,000 versus an investor that puts in $2 million. An investor that puts in $2 million, they want to have hour-long phone calls maybe once a week. They want to have lunch once a month, and they take up a lot of time, and they want to have influence in the direction the company goes. The $500 investor or the $1,000 investor, they're excited to be a part of this journey. And, you know, they want to test new products. They want to be in the know of what's going on. And so we give them an update, you know, a fun update once a month. We have a quarterly webinar with them to kind of talk about our recent quarter and how things performed. And then we have an annual shareholder meeting as well. And that really provides all the information that these individuals will need to know. And then you get the benefit that they give you. So it really is a tremendous thing. And I think a lot of our entrepreneurs on the platform would echo that sentiment. As I mentioned, we just launched our 3rd Reg A offering. It's now a $41 million raise. So the first Reg A offering that we did was for $5 million. We oversubscribed that. The second Reg A offering was for around $9 million. And now this raise is for $41 million. And so we just launched this a few weeks ago. Kevin O'Leary, Mr. Wonderful from Shark Tank, is a strategic advisor in our company. And that happened over the last couple of months. So he's really been promoting this raise for us, which has brought tons of eyeballs and attention to our platform, which is great. But this is the funding path that we've chosen. We want to maintain control of our company. We believe in all the other benefits that equity crowdfunding provides, and we're not interested in securing venture capital investment. This is our direction. This is what we want to do, and we believe we can get all the capital that we need from these exemptions that are available to everybody today. A little bit more, I guess, on how we use our shareholders. So as I mentioned, we incentivize them to invest in other companies on our platform. And one of the ways we do this is through our owner's bonus. So basically, if anybody invests over $1,000 in StartEngine, what they receive for a 12-month period is they get a 10% bonus on all of the other offerings on our platform. So what we see is somebody will come in, they'll invest $1,000 in StartEngine, and then they'll go make 2 or 3 other investments in offerings on our platform, which obviously helps those companies. It helps our platform. And it's really this beautiful relationship that we get. But I think it's important that we also have it as 12 months for this perk, because after 12 months, we're probably going to be raising more money again. And we want these investors to reinvest in our business. We've seen other companies utilize perks like this. For example, High Leap, the company, an athletic apparel company, that what they do is they offer a 50% discount on their product to anybody that invests in their business. So somebody comes in and invests, they then go on the High League website, they buy product and apparel at 50% discounts, and then it's just, this never-ending sort of cycle. So I really encourage companies to think hard about how to utilize perks to the best of their ability. But that's one way at StartEngine that we do it that's been very effective. And as I mentioned, some of these other things earlier on, but these shareholders really are doing more than just investing in our company. They're bringing other deals, they're bringing employees, they're giving us feedback all the time, which has been very, very valuable for our team to understand. So that comes to the end of our presentation today. I want to then get to all of the questions. I know that we've had a lot come in here as I've been presenting. So I definitely want to see that. And if you do have questions, I encourage you to submit those via the Q&A section here on the Zoom toolbar. So I'm going to stop sharing my screen right now and start to address some of these questions. So we have a question here regarding what recommendations do you have for applications to StartEngine for pre-revenue companies? So I think it's a really good question. And first, let me just take a back up a little bit to explain. So StartEngine, we are an application-based platform. So we do review all of the companies that are interested in raising with us to see if they're good fits for our platform and for the investor base as well. Revenue is one of the things that we look at in the applications, but it's not the deciding factor by any means. I think really what we want to understand when we're evaluating these companies from an investor risk standpoint is, number one, what does the company do in a very short, simple description? Number two, why is this compelling? Why is this a disruptor? Why would the general public care about what it is that you do? Number three is, what type of traction do you have thus far with this idea? Do you have a prototype? Are you out in the market selling? If so, what do the numbers look like? Sort of what tangible results do you have thus far that then we can point to on an offering page? And then number four, who's behind the team? Are you guys, is it a seasoned entrepreneurial team that have, this is not their first startup. They've had successful exits. Those are some of the things I think that we want to understand more about a company. We do also ask for financial information in the cap table so we can kind of see what's under the hood, make sure that it's not a toxic deal by any stretch of the imagination. So I think those are some of the things that we'd like to see. And just because you're pre-revenue doesn't mean that you're not a fit for StartEngine. So I'm curious how exit options view a cap table with perhaps thousands of shareholders. Well, I don't think there's any sort of negative feeling on that. As I mentioned to you, these shareholders are common shareholders, so they own the stock that the founders of the company own, and they also don't normally have a vote. So while there are a lot of them, it's not a messy cap table. A messy cap table, in my opinion, looks like I've got 7 different classes of stock. These people have certain rights, those people have certain rights, and that's what a messy cap table is. And that's what I think some of these, VCs will get concerned about. But I don't see them being concerned about a company that has 10,000 common shareholders that don't have a vote, one class of stock, especially when these VCs are going to come in on preferred shares anyways. They're going to come in above the common shareholders, so there's no risk to the venture capital firm, and it's just one group of people. So I really don't think there's any sort of concerns about that a VC will have, and especially, we've had companies that have gone on to secure VC financing after raising on StartEngine. One company that comes to mind is MedAnswers. They raised a few $100,000 on our platform, and then they went on to raise $5 million from a VC. So clearly, I think if you're the right deal for a VC, they will invest in you, and that's just the bottom line. Let's see. How does funding through your platform break down by sector in amount raised? For example, life science, B2B, consumer product, etc. It's a really good question. So I think in the early days of equity crowdfunding, consumer-facing companies were the norm and really were the sweet spot, because consumer-facing companies, it makes sense. You go out to your customer base that already loves your product or service, and you get those people to invest in your company. That was the early days back in 2016, maybe 2017. Since then, the industry's really matured and developed. And what we see now is companies that have very compelling missions and stories as to why they do what they do and are truly disruptive. Those are the companies that are going to have the best chance to succeed on StartEngine. That could be a consumer-facing company. That could be a B2B company. It could be a software company. It really doesn't matter. But as long as you can show to the general public why you're so compelling and why they would care about this investment opportunity, that's what matters. So I really think that we've seen that the industries have varied tremendously. You know, we've seen such great success with green tech. The general public is passionate about that and trying to, you know, preserve our planet and things like that. Those types of companies perform really well. They tend to be more B2B businesses though. So, you know, biotech, that's another space that's done really well on StartEngine. Finding cures for diseases and things of that nature. The public is passionate about those things. And so we've seen tons and tons of success with companies like that as well. And you don't need to just be a consumer-facing company to find success here. Another question, what are the conditions to go from Reg CF to Reg A? It's a good question. So with Reg CF, it's a pretty straightforward process. We put together an offering document that includes financial statements. All that's done via StartEngine on our platform. And once it's done, we file it with the SEC. Once we're filed, the company can start raising capital immediately. When the company's raising on their Reg CF round, as we see the campaign progressing and as we see the company maybe eclipse the 500,000 mark or the 600,000 mark, that's when then we want to start getting a Reg A process in motion. Because a Reg A does require the SEC to qualify the offering. So we have to file everything with them. They review it. There's normally a couple of rounds of back and forth before the SEC qualifies the deal. And that process can take around 3 to 4 months. So we really want to get that started while we're in the midst of the Reg CF offering, assuming that Reg CF raise is going well. The other sort of major difference between Reg CF and Reg A is for Reg A, the company needs audited financial statements. Whereas for Reg CF, the company just needs reviewed financial statements. So there's going to be that transition as well as moving from a review to an audit. And so the sooner we can get that started, the better. Another question here, do reports filed under Reg CF need to be audited by a CPA firm? So we just touched on that. The first time a company takes advantage of Reg CF, they just need reviewed financials. It's the second time or beyond that a company, if they want to raise the maximum amount, they will need an audit. But for the first time, which is going to be the majority of people, a review is satisfactory. Only the second time and beyond, if you try to raise the max amount, you'll need audited financial statements. When do crowdfunding investors have the opportunity to sell their shares if they need the money or are not pleased with the direction the company is going? It's a really good question. So Reg CF, the securities that people purchase, they are restricted from any sort of transfer for 1 year. After a year, they are freely transferable. Reg A, the shares and securities that people purchase are freely transferable immediately after the offering. So there's no restriction on transfer. What StartEngine has been working on for the last several years is to provide a secondary trading platform that will allow investors to receive liquidity. As you all know, when you invest in an early stage company, it could be 5 to 7 to 10 years before the investors see anything back on their initial investment, if at all, right? These investments are inherently very risky, and many of the companies will not go to where they end up wanting to go. But what StartEngine is doing is providing a trading platform that will allow these companies to actually trade their security and get liquidity sooner than that time frame if they want to. It is the company's decision to list on our secondary trading platform. So the shareholder just can't go and start trading those shares at their own prerogative. The company will need to provide or list on our platform and provide that liquidity to investors. but this is something that's really going to, in our opinion, change the industry tremendously. And if a company can offer liquidity to shareholders, it inherently makes your investment opportunity that much more attractive. So by having this secondary trading solution, we think it's only going to increase the size of the raises that are going on our platform considerably. Can you talk about valuations for a startup and how you value a company for the potential shareholders? It's a great question. It's not an easy question to answer. Setting a valuation is, there's no right way or wrong way to do it. But I can tell you that companies on StartEngine, here's the way they go about it. First off, we as a platform require a reasonable basis for the valuation. So you can't come to us and say, my valuation is $100 million because I say it is. You need to actually show us how you got to that number. And in some way that companies do it, could be a multiple of revenue. Hey, I've got, $1 million in revenue and I'm doing a, 5-time multiple for $5 million valuation. It could be a comparable analysis. So, we're in the solar energy space, and, there's been a ton of investment in solar energy companies like XYZ, and the numbers on those raises were this. Us compared to them, here's where we're at. And so we're discounting our price by this amount to come to a value of whatever the number is. So you can do some sort of comparable analysis there. You could do a discounted cash flow analysis if you want to get really technical with it and sort of project future earnings and what the company could or is projecting that they will receive, and then discount that back down to present day. And so that's one option as well that companies have done. Things that make companies valuable are, patents and trademarks and IP and those types of things that obviously will factor into the valuation discussion. But StartEngine is here to help companies with that. We've done it obviously for hundreds of companies in the past. Generally, the way that we like to do it is we ask the entrepreneur, do you have a number in mind that you're thinking? And they normally do. They normally say, yeah, I'm thinking $7 million for my company. And then what we'll say is, yeah, I think that's in line based on kind of where you're at. Or, I think you're actually, making the deal a little bit cheaper than you maybe can get away with, or maybe that's too expensive. I think we need to come down a little bit. And here's why we think so. So it's a very collaborative process, but those are some of the techniques and tools that companies will utilize to set a valuation for their business. Are there additional rules that must be followed for companies that return for multiple rounds of funding? There aren't really additional rules besides having to be up to date on your annual or semi-annual and annual reports. So it's, the regulations remain the same. As a part of your offering memo, your previous offering section will only develop further as you just did a round. But there's really nothing additional that a company needs to provide the second or third time they do this beyond just what the regulation requires. As I mentioned regarding the financial statements, especially in the Reg CF world, you may need an audit the second time you go about this, as opposed to the first time where a review will be satisfactory. But beyond that, nothing extra that a company would need to do. What are the typical valuations on StartEngine? Again, it's a bit all over the place because we're helping companies of all different sizes and stages of development. So I would say in the Reg CF world, we're generally seeing valuations between, I would say 7 to 12 million, just as a rough kind of range there for $1 million offering. That's typically what we see. Again, there are always exceptions to the rules. Reg A tends to be higher. Again, some companies are much more established and further along, so you might see a valuation maybe in the $100 million range, but I'd say probably more common, you're going to see it in the 30 to 50 range for a Reg A. But what we do is we sort of tier it up, right? So if the first round is for $1 million at a $7 million valuation, the next round will be a $5 million at offering for maybe a $15 or a $20 million valuation. And then we'll maybe go up to a $10 million offering for maybe a $30 or $40 million valuation, and kind of sort of, go on that sort of schedule as opposed to $1 million at 10% and then 50 million at some other, crazy number where you can't justify the valuation increase. Compare Indiegogo to StartEngine. Indiegogo is a rewards crowdfunding platform. And what that means is people are pre-purchasing product or donating money. So they're not actually receiving a security in exchange for their donation or their backing. StartEngine is an equity crowdfunding platform. So it's based in the security offering, the security in the company. So companies are selling equity, they're selling debt, there's a convertible note. Inherently, that's what the investors are purchasing. In addition to the security, you could also offer perks similar to an Indiegogo, where you can give away product or things like that. But at the foundation of these offerings, companies are selling securities, and that's the major difference. What are the cost estimates and how much do you charge, meaning StartEngine? So it's a really good question, and it's pretty consistent, actually. So for Reg CF, the $1 million and under rule, we charge 7% of the raise in cash. We charge 2% of the raise in the security that you're offering, and then there's a $10,000 service fee that gets taken out on the back end the first time the company withdraws money from escrow. So just to recap that, if you raise $1 million, StartEngine will take $70,000 in cash. We'll take $20,000 worth of stock in the business at the same price that you offer on our platform, and a $10,000 service fee. So basically $80,000 cash, $20,000 worth of stock. For Reg A, it's 7% of the raise in cash, 2% of the raise in the security that you're selling, and that would cap our fees on the Reg A side. What is the typical type of equity instrument offered by companies on the platform, i.e. preferred or special class, et cetera? Yeah, so the traditional instrument that companies are selling is common stock. It's generally the common stock that exists within the business when you incorporate the company. However, the common stock is sold with a disclosure that sets up a proxy so that every individual forfeits their right to vote to the CEO of the company. Because the general common stock has voting rights and preferences, but including this proxy disclosure basically forfeits the individual's right to vote to the CEO. So you're basically selling non-voting common shares without having to set up a new class of stock. And that's what's by far and away the most common instrument that we see on StartEngine. It's what actually StartEngine ourselves, that's what we offer through our crowdfunding campaigns. We have seen a few preferred share offerings. We've seen some convertible note offerings. We don't really see much debt, to be honest. It's very infrequent. But the common share with a proxy is by far and away the most common instrument that's sold on StartEngine. What happens to the investor money if we do not meet our set investment goal? So the way that StartEngine does it is you have a minimum target and a maximum target. The minimum target is, let's say, $10,000. That's our platform standard. The maximum can be as much as $1 million. As soon as you surpass $10,000 in your raise, you have options. You can either begin to withdraw funds as you go, as many times as you like throughout the offering, so rolling disbursements, or you can wait until the end of the campaign and decide whether or not you want to close on those funds at all. So let's say the company says, listen, I don't actually want to close on any money unless I hit $500,000. Well, if the offering goes to $450,000, and because your minimum was $10K, you can decide, listen, I'm going to cancel it. I'm going to return all money to the investors and be on my way because the $450,000 to me is not worth it. On the other side of it, because your minimum was $10K, if you hit $450 and you really want that $450, you can close on that money and take it home with you. So you have these options available to you via our platform, and that's how it would work. Let's see here. Our parent company is in Canada, but we have a subsidiary in the US. Can we raise under our sub? Yes, you can raise under the sub. Now, there are some things that we would look at StartEngine, so it's not just automatic. Generally, we'd like to see that there's a US team as well with the company. There needs to be US bank accounts, all those types of things. I also think one of the things that we like to understand is, what's valuable about the US sub. Where does all the IP reside? Is it in the Canadian entity? Is it in the US sub? Patents, trademarks, all those types of things, because we want to make sure that the US sub is a valuable investment opportunity for the investors, and not just, hey, I want to access the US market, so I created this US sub so I can raise money from the US market. So it's something that we can look into further, and I would encourage you to reach out to our team to kind of have those discussions to see if it would be eligible to raise on our platform. If an accounting firm filed tax returns and are doing the books, does that constitute an audit? No, it does not. So you would have to work with an independent CPA, which StartEngine can provide to you, and that independent CPA would perform an audit of your financial statements from the last 2 years. If you haven't been around for 2 years, then since inception. But the audit, there's requirements and standards that these CPAs need to meet to test your financials in order for them to kind of provide their audit report that is ultimately required. So it's definitely a much more extensive process than just filing tax returns. There is definitely more involved to getting an audit done. How can I go for a pre-seed? You come to StartEngine, you speak with one of our sales representatives and provide us the information that we're interested in understanding about your business to see if it'd be a good fit to raise on our platform. And if so, then we proceed with onboarding your campaign and launching your offering. And we could actually onboard and launch campaigns now within a week's time. The SEC came out a month or two ago during this COVID period, and they now have basically loosened the restrictions on companies to be able to launch an offering. So we can launch an offering very, very quickly and help you raise the 500,000 or whatever it is that you're looking for, and be live out in the markets raising in about a week's time. So I encourage you to reach out to our team and see if it's something that works for you and for StartEngine. How much does StartEngine charge to perform documents a company to get a company ready to engage in your platform? So we don't actually charge companies anything to prepare their documents. All of our fees, as I covered earlier, are taken on the back end. There could be costs involved to the company to get their legal documents in a place that is required for regulation crowdfunding or Reg A offering. For example, the majority of companies on our platform will raise money as a C Corp. So a lot of companies at this early stage are normally set up as an LLC. But in order to raise money from thousands of people, an LLC really isn't the right structure for that, because you don't want to have to issue 1,000 or 2,000 K1s at the end of every year. That would be an accounting nightmare. So what the companies will do is they will convert from an LLC to a C Corp, and there's some time and some cost involved in doing that. There might also need to be some adjustments to the corporate documents. The company may need to authorize more shares, whatever situations that may exist. So there is some pre-work potentially that's involved with it. StartEngine is very involved in helping companies through that. But ultimately it's security attorneys and or CPAs that are doing that work. And we would introduce the entrepreneur to those vendors to provide those services. How long can a company expect to wait for a response from StartEngine after they submit their application? We try to be as quick as possible. We really want to get to these applications within 24 to 48 hours. Now, as you can imagine, the demand is extremely high, and so there's tons and tons of applications for us to go through. But we take pride in trying to get back to everybody as quickly as possible. So if you submit an application and have not heard from our team within 48 hours, you should absolutely reach out to our team. You can send a message to hello@startengine.com. It's our sort of general service email, where our team will be able to respond to you and let you know where things stand. But we really do try to be as quick as we can in getting companies' feedback on their applications. Are companies in the brewing or beer, seltzer, or spirits eligible? Yes, absolutely. It's actually been an incredible space for our platform, the alcohol beverage space. We just raised $1 million for a distillery company up in the state of Washington. We raised another $1 million for a spirit vodka company. We've got a few tequila companies on the platform. Breweries have always performed very well. So alcohol beverage is a great space for equity crowdfunding, and StartEngine's already had a lot of successes there as well. Let's see. Do you support safes? No, we do not. So StartEngine does not allow safes on our platform. We haven't been for almost probably 3.5 years. We've done, I believe, 1 or 2 safe offerings back in the very early days, but after those raises, the SEC actually published a report hinting that safes, they did not believe it to be an appropriate instrument for non-accredited investors. So at that point in time, we banned safes from our platform entirely. And I mentioned earlier about how the crowdfunding rules are going to be increasing their maximum amounts from up to $1 million to $5 million and $50 million to 75. As a part of those rule improvements, one of the things on the table is actually eliminating safes entirely from regulation, from these 2 exemptions. So we're not going to be allowing safes. They're probably going to be banned entirely from our industry very soon. And so it's just, the SEC does not believe it's a good instrument for non-accredited investors to be investing in. How is investor information provided to the company, such as in an Excel spreadsheet or some other format? Yeah, so we provide all of the investor data and information to our customers once the investment has been dispersed upon. So when the investor puts money into escrow, they're actually not an investor yet at that point. They only become an investor once the money moves from escrow to the company's own bank account. And when that process happens, then the investor data and information becomes publicly available to, not publicly available, but available to the company. We would provide this via CSV. It has all the data and information that you would need so that you could, keep track of all those things. You can send emails and whatever information that you would need to your investors. So we got time here for just one more question. Can a company be denied to raise capital on StartEngine? And if so, what will cause them to be denied? Yes, a company can be denied to raise on StartEngine. We have eligibility requirements for our platform. First off, there are eligibility requirements for the regulation. So you got to be a U.S. incorporated business, and you can't be in certain industries. We have a banned industry list on our platform as well that we abide by. So those are kind of the first disqualifying things. Beyond that, if we feel that the investment would be inherently too great of a risk for our investor base, we have the obligation to reject those companies as well. And so those are some of the things that we evaluate in our application process. But yes, we do have to reject some companies from proceeding with StartEngine because of those criteria. So I think that's basically all the time that we have for today. There are just a couple more questions. I'll try to kind of get to those maybe after we can sort of type our responses to you. But in the interest of time, I do want to wrap this up. But thank you all so much for tuning in and attending today. If you're interested in moving forward with the capital raise, I encourage you to go to startengine.com/raise-capital. Again, startengine.com/raise-capital. And you can get started there, and one of our sales team members will be able to reach out to you and speak further about your company and StartEngine's platform to see if this has been a great fit. But you can also reach out to me. My name is Josh Amster. Email is josh@startengine.com. We've put the link here in the chat feature. So if anyone wants to click on that, you're more than welcome to start getting started with the application and discussing things further with our team. So thanks again, everybody, for tuning in, and hope you have a great rest of your day.